All right, today we're going to peek inside the machine of corporate accounting. We're talking about one of the most powerful tools out there for investors and analysts, IFRS 8. That's the standard for operating segments. Let's jump right in.
So think about a giant company like Disney. Is it one business? Of course not. You've got the theme parks, you've got Disney Plus, the movie studios, the cruise ships. I mean, it's a whole collection of different businesses all living under one roof. So how on earth do you know which parts are actually making money and which ones are struggling? Well, that's the exact problem IFRS 8 was created to solve.
So here's how we're going to break it down. First, we'll look at the big idea, the view from the top. Then, we'll define what an operating segment actually is. After that, we'll see how a segment gets important enough to be reported. Then, we'll open the books and see what gets revealed. And finally, the most important part, why it all matters to you. Okay, let's kick things off with section 1, the view from the top. This is all about the really simple but kind of revolutionary idea that powers this whole standard. You see, the whole goal here isn't to create a bunch of confusing numbers just for accountants. It's actually the opposite. The point is to give you, the user, a clear, honest look at all the different business activities a company has going on, so you can see for yourself how they're performing. And the way it does this is through something called the management approach. Now, this is the absolute key takeaway. The whole point of IFRS 8 is to let you see the company through the exact same lens as the people running it. The financial reports you get should look like the ones the top dogs are using to make their big decisions. In other words, you get to see what the CEO sees. Okay, so if we get to see what management sees, what are they, seeing? That takes us right into section 2. What exactly is an operating segment? Think of these as the basic building blocks of the company. So, an operating segment is basically any distinct part of the company that checks 3 boxes. 1, it's out there doing business. 2, the people in charge are regularly looking at its results. And 3, it has its own separate financial information. Let's break those 3 tests down even more. First, it has to be a real business unit. One that earns revenues and spends money. Second, its results are being reviewed by the CODM. And third, you can actually pull separate, specific financial data for it. Now that acronym, CODM, that stands for Chief Operating Decision Maker, and that's a really important concept. And what's so interesting is that the CODM isn't necessarily one person with a specific title like CEO. It's not about the title, it's about the function. Who or what group is actually in charge of allocating resources and judging performance? Whoever's making the big strategic calls on where the money and effort go, that's your CODM. All right, so we figured out what a potential segment is. But a massive company could have dozens of them. They don't have to report on every single one. So that brings us to our next question. How does a segment actually make the cut? Well, there are 3 main quantitative tests, or hurdles. The first one is a simple size test based on revenue. If a segment's revenue is 10% or more of the combined revenue of all the company's segments, then boom, it's on the list to be potentially reported. The next test is about profit or loss. And this one's pretty clever. A segment is reportable if its profit is 10% or more of all the profitable segments combined, or if its loss is 10% or more of all the money-losing segments combined. The key here is you can't just hide a division that's losing a ton of money. If it's a significant loser, it has to be reported. And finally, we have the assets test. If a segment's assets make up 10% or more of the total assets of all segments, it's in. And here's the crucial part. A segment only has to pass one of these 3 tests, revenue, profit/loss, or assets, to be considered. Just one. But wait, there's one final check, kind of like a safety net. It's the 75% rule. Once you've found all the segments that pass those 10% tests, you have to add up their external sales. If that total doesn't reach at least 75% of the company's total external revenue, management has to start adding more segments, even smaller ones, until they cross that 75% threshold. This stops companies from hiding the bulk of their business in some vague other category. So, a segment made the team. It's officially reportable. What does that actually mean? What info do we get to see? Well, now it's time to open the books. For every single reportable segment, companies have to share some really vital data. We get to see the revenue, split between outside customers and sales to other internal parts of the company. We also get their profit or loss and their total assets. This is the good stuff, the raw data that lets you piece together the corporate puzzle.
And this table right here shows you exactly why this is a game changer. Just look at segment B. It brings in the most revenue by far, $800 million, but it's actually losing $20 million. Meanwhile, the smaller segment A is quietly driving the profits. Without this breakdown, all you'd see is the total profit of $65 million, and you would completely miss the real story happening under the hood.
Okay, we've gone through all the technical stuff, the what and the how. Now for the part that really counts, Section 5. Why does any of this matter? Why should you care? Because this is how you become a much, much smarter analyst.
At the end of the day, segment reporting gives you incredible insight. You can finally answer questions like which divisions are the real cash cows and which ones are just a drain on resources. Where's the company actually investing its capital? You can see that in the assets. You can spot huge risks, like if the company depends way too much on just one product. And maybe most importantly, you can see if what management says their strategy is actually matches the financial reality.
So I'll leave you with this one thought. Next time you're digging into an annual report, go find the segment information. And yeah, look at the big segments they're highlighting. But then give some extra attention to that little line item that says all other segments. Ask yourself, what's hiding in there? Is it a bunch of exciting new ventures? Or is it where the underperforming businesses go to disappear? Because sometimes the story of what's not being highlighted is the most revealing one of all.